and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, February 17th, 2022, and I'm pre-recording this Trading Places Live for just a bit later this morning. Currently, we have futures that are down a fair amount. We got the Dow futures currently down about 100 points, or a little less than 0.3%. S&P 500 futures are down 16, which is about 1/3 of 1%. And the NASDAQ down 71, their futures, which is just about 1/2 of 1%. So we got options expiring tomorrow. Been a little bit of a volatile week back and forth. We'll see how we finish it. Once we get through the options expiration, which I think maybe could be helping to try to lift prices here in the near term, I suspect you'll want to be careful back to the downside. Of course, the market can do anything, but just based on the way the patterns are set up and based on all of the signals that I've received over the last several weeks, which I've been talking about quite a bit, I would expect that the path of least resistance after options expiration is to the downside. We'll see. Agenda for today, I'm going to go through and recap that market for you from a Wednesday. So we'll start with that daily market recap, jump into talking technically. I'm going to take a really long-term view, take a look at the PPO based on a longer-term chart, just show you where we are in history. Then we'll get into industry rotation, earnings spotlight, and the 3 you must see. Before we get into any of that, let me take you over to Earnings Beats. For those of you that are new, welcome first, and make sure you go over to earningsbeats.com and scroll down. You can sign up for our free Earnings Beats Digest newsletter. All it requires is a name, email address. We'll send out that newsletter 3 times a week, Mondays, Wednesdays, and Fridays. Very quick read. Usually it's just maybe 2 paragraphs and a chart. Could be a chart that you might want to trade. Could just be one that you kind of follow along, the way we look at the chart, learn a little bit more about relative strength and how we approach earnings and gaps and candlesticks, all those types of things. So we'd love to have you if you would like to join. Also, we do a lot of free events, and when we do, we reach out to this entire community and provide the room details and things like that. So if you're interested in coming to some of our educational events, this is another great way to do that. Let's move on. Actually, before we move on, let me there is an event that we're having on Saturday, and you can see here, February Educational Series. You can click on this link to learn more. We've already had 2 events. We had the January effect back on Saturday, February 5th, and that just told us to be careful, because when the market is weak in January, the tendency is for the market to struggle the balance of the year. The second event that we had, which was last Saturday, February 12th, that was the anatomy of a cyclical bear market. Went through and discussed all of the bear markets that we've had since 1950, and placed them in their proper category. Cyclical bear market versus secular bear market, big difference there, by the way. And so if you're a member at Earnings Beats, you can go back and review that recording. The January effect actually is a free recording that you can check. And then this Saturday, we've got the most overlooked growth stocks. I believe we're going to peak in inflation probably within the next couple of months. And when we do, I suspect that growth stocks are going to absolutely explode to the upside. That's the history of the stock market. When we top in inflation and we begin to pull back, inflation comes down, expectations come down, growth stocks on a relative basis tend to absolutely explode. So I think now's the time to be doing your homework, not waiting until after you see the market go up and growth stocks go up, and then 6 months later, everybody from the professional world, the Goldman Sachs of the world, come out and then start telling you the market's fine. You want to know when it hits bottom, or as close as we can. And so this is part of getting ready and getting prepped for that. All right, let's move on to the daily market recap. The daily market recap, you can see Dow Jones Industrial Average on Wednesday was down 55 points. S&P up 4, NASDAQ down 16, mid caps were up 7, small caps up 3. So a little bifurcation there. Most of the indices, though, were pretty close to where we had closed the prior day. So there wasn't a whole lot of movement there. We did see money rotate back into energy, which was the area that led the market on Wednesday. Materials also up nicely, both of them up around that 0.75% mark. Industrials up about 0.5%. Discretionary up a little more than 0.25%. The loser, and quite honestly, the big loser really for the past 3, 4, 5 months has been communication services. They were on the bottom of that sector leaderboard again, down close to 0.75%. All right, the 10-year Treasury yield. Well, first off, this morning we will have some economic reports coming out. We're expecting the January housing starts to come in a little higher than December. December was 1,702,000 units. January expected to be 1,708,000 units. January building permits, 1,760,000 is what's expected. That's down quite a bit from December's 1,873,000 units. So that's a 113,000 unit drop, or maybe about 6%. Initial jobless claims. Of course, it's Thursday, so we always get the initial jobless claims on Thursday mornings. Last week, 223,000. This week, we're expecting 224,000, so relatively flat there. And then the February Philadelphia Fed Manufacturing Index. In January, it was 23.2. February, we're expecting it to drop to 19.7. So those are the key economic news releases that you will see this morning. As far as the 10-year Treasury yield goes, we're continuing to move higher. Haven't really heard a whole lot about inflation this week. Like I said, for the market, it'd be better if we went a little bit higher. So I'm not shocked that we don't have a whole lot of media coverage right now. But if you were paying attention on Tuesday morning, you saw the PPI come out, double what was expected. Expectations were for, I think, 0.5% increase, and it was a full percentage point. And if we strip out food and energy, the expectation for the core PPI was, I think, also 0.5% rise, and that came in at 0.8%. So the inflation story is still alive and kicking. It's just that this week isn't a good week to talk about it. So I say that with a little bit of sarcasm. Also, I think yesterday the industrial production numbers were much higher than expected. And I had been saying, you know, if we're really going to look at higher inflation, probably need to see these industrial production numbers pick up. And that's exactly what we did yesterday. So that was very inflationary. But again, for whatever reason, didn't seem like that was in the news stories. Most of what we heard about was Russia pulling away from the border of Ukraine, which is a great story, don't get me wrong, but probably doesn't have nearly the impact on the stock market as the inflation news did. But we weren't really talking about that. So everybody be quiet. Let's not bring that up this week. Next week, different story. And I'm saying that sarcastically because this is options expiration week, and there's a lot of in-the-money put, net in-the-money put premium. And so it actually would help if the market would do a little bit better this week. So anyway, just throwing that out there. It's kind of a crazy week right now, and we'll see how things finish at the end of this week. But I believe by the time we roll into next week, I wouldn't be surprised to see the market roll back over again. So please be careful out there. All right, moving on. Let's go into talking technically. So here is a 50-year chart on the S&P 500. It's a 50-year monthly chart. And I thought I would just point out where we stand historically from a PPO perspective. Now, remember, the PPO is the 12-period moving average versus the 26-period moving average. The difference on a percentage basis is the PPO. So 12 months is a year. 26 months is a little bit more than 2 years. So, and if you look back the last couple of years, we've been straight up, and that normally is going to send your PPO up. And there've only been a couple times in history where we've seen the PPO as strong as it is now. And actually, I had a question recently that asked, what's the difference between the PPO and the MACD? This will be a perfect example to show you why I use the PPO now instead of the MACD. They're essentially the same. They're calculated using the 12-period moving average versus the 26-period moving average. The MACD is expressed in dollars, though, whereas the PPO is expressed in percentage. So when you're looking at this, first of all, let's just talk about this monthly PPO, and then I'll show you what it looks like on a MACD. Here's the monthly PPO. Right now, we're sitting at 10.02, and we were just up around 11. And if you look back over the last 50 years, only twice in history have we gone up above 10. That's a really the percentage difference between a 12-month PPO and a 26-month PPO. You can't get to 10 by just having a little bit of short-term strength or having, breaking out and rallying for a few months. You need to have a very long, extended bull market to get PPOs up to 10. Here, you can see we've last 2 years coming off the pandemic low. Yeah, it's been pretty much straight up. Also, we only had one monthly reading that was down for very long, and then we were right back up again. So even though we got hit pretty hard on a monthly basis, it really doesn't have nearly the impact. So it's really just looking at where you were 12 months and 26 months ago and seeing where you are now. The late 1990s, you can see we had this huge run, and the PPO got up to about 13, maybe even a little over 13. That was the highest ever. 1987, right before the crash, we got up to 12 and a half. Huge move in the mid 80s. And then we had this big drop. What might be lost here is when we got up to 13, we actually had a cyclical bear market right here. You might look at that and say, well, wow, that's just part of the uptrend. That's not really that big a deal. I mean, you might look and say the same thing about the pandemic at this point, right? I mean, that was down 35%, but it looks like just a blip on the radar, which I said back then, that's what it would be, was a blip on the radar. This year, I think we're going to have another cyclical bear market. I think we've started it, and I think it's going to be a blip on the radar. I think it could look very similar to what we see right here back in 1998. Wouldn't be surprised to see us weak just for a period of time, maybe for a few months to reach a low. Maybe we consolidate for a bit, and I expect we're going to move back higher again. So something like that, between 20 and 25, maybe 27% downside move is what I'm expecting, not 50 or 60%, which is what we typically see during these secular bear markets. Cyclical look like this, or even like this, or even like this. Secular are these long-term things that go down for a long time. I don't see that. I see more of a short term, but I don't think it'll be like the pandemic. I think we're probably going to go a little bit below that 20-month moving average, maybe intra-month, and then by the end of the month, we come back up above it. I don't know how it'll play out. Maybe go below for 1 month and then right back up the next month. But I think that 20-month PPO, which during secular bull markets generally holds. I mean, you can see we went down below 1 month. That was the end of 2018. That was a cyclical bear market right there. 20% down. Went down, came right back up above it. 2015, 2016 went down slightly and below it, the 20, and then back up. One thing that's interesting is that during this secular bull market and during this secular bull market, we never had a monthly close below the 50-month moving average. Here we went below it, closed back above, and then we gapped down below it and then right back above. But we never had a monthly close during this entire secular bull market. So anyway, I thought this was kind of an interesting chart to show you. But when you get this PPO up here, you're going to roll over. It's just unsustainable to keep that PPO up this level for much longer. And you can see ours is already starting to roll over. So I think what we'll do is we'll probably get a pullback. I think it'll be a fairly brief one, maybe something like this. That's the 1998 move. So maybe from 11, we go down to about 6. And then I would think we're going to start to move back higher again. Maybe somewhere down the road, there's more, maybe we have a recession. I don't know. And maybe we'll have another decline for a period of time, another cyclical bear market. But I think this one probably is going to cap somewhere around between 3,500 and 3,800. That would be my guess. All right. Let's look at the NDX, the NASDAQ 100 on a monthly chart, see where we are there. Well, the NDX, the NASDAQ, which got absolutely crushed during the dot-com bubble, Well, it also, I mean, look at this move. Talk about parabolic move. That was a parabolic move in the late 1990s. The monthly PPO got to 30. 30. I know everybody's thinking this is 1999 all over again. I don't believe that at all. We got to 15. I mean, we definitely had a big move here on NASDAQ shares, and we deserve more of a drop than just the 20-month moving average. We've already tested it. I think we're going below that. Where do we bottom out here? I mean, I'm thinking the NASDAQ might go down to 12,000, maybe into the 11,000s, and get down close to the 50-month moving average. That's what I think. That's what I believe is going to happen. We'll see. That's a bold call. We're still at 14 and change. But remember, I didn't just start talking about this like the last couple of days. I talked about this at the end of December when we were at all-time highs. There were just signals telling us that you needed to be careful. It's never a guarantee, but it was telling us to be careful, whatever that means to you, whether it means moving to cash, whether it means just moving more defensively, whether it's getting put insurance, something. And if you did that, then I think these last 6 weeks have been much more bearable, and maybe even profitable, depending on if you decided to short. But anyway, I thought that was kind of interesting. Now let's go back. I want to go back to that S&P chart because I'm going to switch this PPO to the MACD. So you see the PPO here, not nearly as high as it was back in 99, right? And not as high as we saw in 1987. Well, if we switch out the PPO for the MACD, I want you to take a look at what happens. Wow, look at this. Now it looks like we've never seen momentum like we have now. The MACD up over 400. 1999, we were barely over 100. 1987, what were we at, 20? How can you compare these? I mean, by looking at this, it looks like, wow, the momentum, the bullish momentum is so much better on the S&P right now. That's not true. So one of the things a PPO helps you do is it brings everything into perspective. The reason the MACD is so higher here is because the index value is so high. Remember the difference in the MACD between the 12 and 26 period exponential moving averages. That difference is in dollar terms or in index point terms in this case. The PPO is based on the percentage difference. So if you want to compare 2022 to 1999, here, and to 1987 over here, you can't do it with the MACD. You have to do it with the PPO. I mean, let's take a look at a stock like Apple. And look at the monthly PPO on Apple right now. I mean, it's crazy, right? What if we went to a weekly PPO? I mean, look at these. Does this make any sense to you? I mean, the chart, we've been going up steadily about the same percentage on average over these years. But the MACD has gone absolutely nuts. Here, the MACD is up to 12.5. You go back into when we started this move almost 20 years ago, MACD was down near 0. That's because the price was down at 1. Price is now at 172. And if we flip this now to the PPO, then you'll get a better look at relative momentum. So how does the momentum compare right now on Apple versus its history? You see the difference? So PPO to me is just, it's better. Most cases, there's not much difference. If I pull up a daily chart of Apple, let's just pull that up. So here's a daily chart of Apple, and there's your PPO. Now, I'm just going to add to this chart. I'll just put it below here. Let's add the MACD, which is an acronym, by the way, for moving average, convergence, divergence. Look at the two. On a daily chart, when you look at them, you probably think, what's the difference? Why not use the MACD? I mean, why do you use the PPO? It's the exact same thing. I mean, I can't really see. It's like looking two pictures, trying to find anything that looks different. It's almost impossible. The difference is when you start looking at longer term charts, or if you want to compare the momentum in Apple to say the momentum in Sirius, SIRI, which is only a $6 or $7 stock. You can't use the MACD. Well, here you might be able to because it's flat, but here the MACD is like 6. Well, Sirius, the stock is only 6. So the MACD will never get to 6. It won't even get close to 6. If it gets to 0.6, that would be a huge MACD. So if you want to compare the momentum in Apple versus another stock of a much lower price or a much higher price, you really need to look using the PPO, not the MACD. So hopefully that helps to explain. All right, let's move on to industry rotation. I just wanted to go over a few industry groups because I know the market's been weak. We're seeing software, semiconductors, autos, all of those kinds of industries really struggle now, and that's having an impact on our major indices. But under the surface of all that, we actually do have some areas that are looking much, much stronger. So if you want to stay on the long side, I would just avoid many of the technology areas and many of the consumer discretionary areas, although I think I have one for you here that has turned up. And I would just focus on other areas where the market is, money's been rotating. So hotels breaking out above this double top. I think this looks pretty good. You also had an equal highs. You had rising lows. So you could say an ascending triangle. Either way, looks to me like this group wants to go higher. So you got a stock like Hyatt, although they reported earnings, they're down this morning, which I'd say probably is a buy, but I noticed that they had a huge miss and they actually, I think, lowered guidance. So you might want to be careful on this one. I mean, if it's going to hold, it needs to hold around that 98 level. But there are others. How about Marriott? Breaking out. Look at the AD line here. Very strong. So Marriott looks like a really nice play. HGV, which is Hilton Grand Vacations, trying to make the breakout. Haven't quite made the breakout, but we are almost right up against that resistance near 56. So keep an eye on that one for a possible breakout. Then we've got Wyndham Hotel. False breakout yesterday and a pullback, but I think anything off that 20-day moving average would be a buy. I expect a breakout here. How about something like the travel and tourism? All of a sudden moving to about a 3-month high, breaking out yesterday. What about bookings or booking holdings? Just broke out to a new high yesterday. How about Expedia? Just broke out again to a new high. This was the earnings gap up. When it pulled back, I talked about anything under 190 being a great entry, right back up to new highs. So Expedia, good report, gapped up, went back, completely filled the gap, tested the breakout area, stayed above the 20-day, and now we've right back to new highs. One other thing with booking, if I pull up the seasonality, this is always one of the crazy seasonality charts I like to bring up. Go back 20 years and look at all the strength February through April. What month are we in? February. Just broke out. Look at these average returns over the last 20 years. February 10.9, March 3.4, April 6%, May 5.4. I mean, this company averages about 24 or 25% during the February through May period. That's an average over 20 years. So you go back and you look at the chart, and here we are in February. Suddenly, we're starting to make a move and breaking out. We're already up 250 points in the month of February or close to it. That's 10%. There's that 10.9%. We've already gotten it this month. So booking, very interesting because of its seasonality tendencies. All right. A couple of other areas I'll show you. Life insurance in the financial area. All of a sudden, looks like a pretty good group, trekking higher highs, higher lows. That's what we want to see. And also in the financials, we have property and casualty insurance setting new highs. So again, if you're focused entirely on technology, software, semiconductor, some of those really big names like that, it's been a rough ride in 2022, but we still have areas like the ones I've just shown you that are much stronger. All right, let's move on to the earnings spotlight. And what I wanted to do here was these are all the companies that reported yesterday after the close or this morning so far, where they're expected to report this morning if they haven't already. And I went in and I put them, we do this for all of our members and for our free members, by the way, in our Earnings Beats Digest newsletter. We put together these chart lists. You can download them into your StockCharts account if you're an extra or pro member. And then you can just sort them and we do all the work for you. And so I pulled this up in summary form and then sorted it based on scooters. And I looked at these bottom three right here. And here's what I can tell you. They all reported earnings and all three were very weak on their charts, obviously. But let me show you these different charts. MTTR came out and I believe they are gapping down this morning. Let's just double check this. Yeah, they're down 20% this morning. They missed their estimates. Look at the stock going down. Relative strength is horrible. AD line's awful. I mean, what were you expecting to come out of this company? Obviously, Wall Street's been selling. Horrible report. But you don't always get a negative reaction, even though relative weakness, there's a lot of relative weakness. Let me show you DoorDash. DoorDash is up 25% this morning to 118. Let's look at this chart. Very similar looking chart, isn't it? I mean, the AD line's going down, relative strength's horrible. We're going straight down. They're up $24. But you know what? They had a big miss on earnings. What I always talk about with relative strength is that a lot of times they'll give us signals as to the type of report that's coming out. But when it comes to market reaction, we honestly have no idea what is going to happen. And these two stocks, I think, are a poster child for what I'm talking about. Both missed earnings. Both were in serious downtrends. Wall Street throwing both of them, out. Don't like either one of them. And yet one goes down 20%. The other one goes up 25%. That is the risk of going into an earnings report. And I don't know how to draw that risk any clearer than that right there. All right, 3 you must see. Let's start off with Court. Court made a big move yesterday, gained almost 13%. Started showing some pretty good strength, though, here over the past few weeks. Almost all hollow candles, telling us that there's accumulation. Look at the AD line. Now, it's got a little overhead resistance, but 23 to 24, if it settles in there and then pulls back, I would think anything back down close to the rising 20-day would be a nice entry point here. Now, this one, I don't know about an entry point. Lazy Boy with their earnings after going sideways for many months and never closing below 32. Yesterday on massive volume, we closed at 30.15. AD line right back near 52-week low. I would say this one is toast. You might get a little dead cat bounce, but my guess is we see lower prices ahead here. How about Angie? Angie's list, same thing. Another big breakdown. AD line going to new lows. You just want to be careful when these stocks break down like this. Relative strength was horrible. Should not have been holding into an earnings report when you get that kind of relative weakness. All right, that's it for me. I appreciate everybody tuning in. Again, if you want to attend this Saturday's event, our educational series, The Most Overlooked Growth Stocks, you do need to be a member at Earnings Beats, but a free 30-day trial member will get that for you. Anyway, listen, everybody have a great day. I'll be back with your next Trading Places Live on Monday over at earningsbeats.com. Just go over to Earnings Beats, and right at the top there, you can click on Trading Places Live after 8:45 and get the next show. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.